Hello traders, welcome back to new video in our exciting series. I am Sanjay from Tribe International and I am thrilled to continue this journey with you. Tribe Hub, where financial empowerment begins. This session is powered by Tribe Hub, a place for all financial education, an initiative by Tribe to empower traders with knowledge, tools, and community support to excel in the financial markets. Video part 1. Today's topic is sideways market. In the last video, we have discussed about advanced trend analysis factors that you can use to identify the strength of a particular trend. But in today's video, we will gonna discuss about sideways market because price cannot stay in a trend for too long and also it cannot stay in a range for too long. Means that eventually a trend will change into a range and a range will change into a trend. So after an uptrend or downtrend, you will gonna see a transition period, a resting period or a cooling off period in the market, and that cooling off period will be sideways market. A sideways market, also known as range bound market, it's a condition where the price of an asset moves within a narrow range over a period of time. During this phase, the market neither trends upward nor downward, creating a horizontal price movement pattern on the chart. So the forces of supply and demand are nearly equal in sideways market. There are two major variations of a sideways market, but which kind of range it is? Because in consolidation we have discussed that there are two phases, accumulation and distribution. So it is important to know that whether a particular range is accumulation going on or is it a distribution. And we as a retail traders cannot form trends or ranges in the market. It is the doing of big institutional players. A range bound market attracts a lot of volume or trading activity in it because the market is designed in a way that it attracts maximum number of trades and maximum volume, because the governments and brokers and many intermediaries in the market are making money by the number of transactions you are doing. They are not worried about your profit or loss. They want turnover charges, security transaction taxes, brokerages, taxes on brokerages. So most of the intermediaries are making money when the volume is very high, the activity of buying and selling is very high. So that is why ranges attracts a lot of maximum number of trades. Look at this GBP USD 30-minute chart where you can see this trend is going on, and this trend took 106 bars to form this particular uptrend, and the volume it formed is just 788k. But if we look at this range after this big uptrend, you are seeing that the range required 208 bars to form it completely, and before the breakdown the volume this range has generated is 1.6 million, which is way above than the uptrend. So you can see here how range bound market attracts a lot of volume, because that is how big intermediaries can make money. So it is the basic structure of market, and the market is always in a search for fair price. Ranges provide an area of agreement between buyers and sellers. It will gonna reflect balance in the market because no buyer or no seller are making money in it, and also not losing any money. So it is a balance between buyers and sellers. They have found a fair value in the market. So that is why a range is created. During a particular range formation, both buyers and sellers are equally exposed to risk and profit. So the probability here is 50-50. And inside a particular range, you may not able to predict the price movement very clearly, because inside those ranges random price movement forms. Instant reversals from resistance area or bounce from support, it is the basic characteristic, and market tries to break out of that particular range to trap many traders a lot of time, and 80% of the time those breakout attempts will gonna fail. So this is the basic characteristic of range bound markets, and it is a 80-20 rule that majority of the time market stays in a range and hardly it have 20% momentum bars on a particular chart. If you look at any currency pair or any stock or any commodity, you will gonna find that market have very low momentum bars forming in it, and most of the time it likes to stay in a range, because in range bound market you will have a lot of trading volume going on. The big question is, why even ranges forms? Why can't the market be trending either on the upside or on the downside? Why we are having range bound market? Because you see, when the trend got started, a lot of big players or retail players have entered in the direction of this trend, and at some point of time what will happen is they will start to book some profit from that particular uptrend, because their unrealized profit is at risk, that the market should not reverse instantly, otherwise their unrealized profit will gonna wipe out. So they will start to form some kind of profit booking pattern there, and many institutional players have big positions, are like 5,000 crores, 10,000 crores orders they have placed in the market. So to enter into a particular position or to exit from a particular position, they need some time. They cannot buy any stock for 5,000 crores in one order only. They need to place small orders, because there is no that much liquidity is available. Plus, if they buy for 5,000 crores rupees, then the market will gonna react very significantly, and their own buying can trigger massive moves in the market, and then they have to pay higher price for buying. Alright, and in the case of selling also, crack the prices too much because of their own action. So that is why range bound market offers those big players to enter or exit from particular trends. Let's see what are the functions of trading ranges. So the first function, as we have discussed, is continuation of trend. For example, if an uptrend is going on, then it will form an accumulation range and it will break out in the direction of original trend, which is upside, and it will gonna continue the uptrend. And the second function is reversal of a trend. Sometimes what happen, a uptrend is going on, then a range start to build up there, and it will break down the support area of that particular range. So it will gonna reverse the original trend from upside, a range bound market, and again to the downside. So very minor difference is there in between accumulation and distribution. So we have to be very careful around it while studying them. Now moving ahead, let's discuss types of trading ranges. So possibly there can be 1,000 variation of ranges because of the randomness. The ranges are random. So why make things complicated? At the end, they all are same with slight variations. So in this section, we will gonna understand some major kind of trading ranges and their logic behind it. So if we understand the logic of range formations, then you can apply that particular logic in identifying those thousands of variation. The possibility is endless. First type is tight trading range. You can see on this chart we have a very good uptrend with small pullbacks forming here, and then the market went into a consolidation, or you can say a extended pullback, and that pullback is in the form of some kind of flag structure. So the range forming here is very tight, and both of the trend lines, the channel trend line and major trend line, is sloping to the downside. And if you look closely here, the swings are forming very narrow, means from this swing high to this swing low, the size and duration is very small, and the candlesticks are forming overlapping with each other, means the range of current candle is somehow inside the previous candle's range. So the bars are overlapping with each other, and it is very hard to make money inside these trading ranges. Let's say if you have bought at this swing low, then it has not been able to hit your target and then again started move down, and if you have short sold at this swing high, then it has not been able to hit your target and went into more tighter range and then reversed from there. So a lot of randomness is there, and not sellers or not any buyers can make money by trading inside these trading ranges. Only scalpers can make money here. One important characteristic of tight trading range is that tighter the range, greater the subsequent move. So as you can see from this tight range, we have had a good breakout and the candle closed above this particular resistance trend line, and then next candle formed totally above the resistance area. So we can say the resistance is cleared. Then it made a small retest in this red color bar and then resumed its up move with a very good momentum. So tighter the range, the greater the subsequent move. So what you can do in tight trading range situations is to avoid trading inside those particular ranges and try to aim for breakouts in the original direction. Second type is wide trading range. The swings are wide enough to make money by buying and selling also. So here both of the players, the buyers and sellers, can make money by trading inside this particular range. You can just identify this wide trading range with the help of two trend lines like this. First of all, why wide trading ranges forms? So the reason is when the market is very volatile, affected by fundamental factors or major news events in the economy, the currency pair would form wide trading ranges because of uncertainty going on. The market is more volatile. So that is why we have wide trading ranges on charts. And what you can do is you can implement buy low, sell high strategy. You can buy when the support area is being tested by the market, and you can sell when the resistance is tested. And you can also initiate some shorts when the market is at resistance area and buy again at the support area. And most important thing, this is a range, alright, and it will gonna eventually become a trend in future. So what you can do is you can implement a breakout trade there also. But as we are in a wide trading range, there will be a lot of fake breakouts going on in the market. On this chart also, we have seen multiple fake breakouts here. So to have proper confirmations of breakout, you can add entry filters like initiate a position when a whole candle is formed above the resistance area. What do we mean by a whole candle formed? It means we need one candle to form totally above the resistance area, including its lows, open and close and high. The whole candle needs to be above this particular resistance. Then only we can say that the resistance area is cleared and a good breakout has occurred, and same thing in case of a breakdown of support area. So this is how you can trade wide trading ranges. You can play inside them, or you can aim for big breakouts. Make sure you understand the logic behind formation of these kind of ranges, because this is horizontal in nature. The support and resistance lines are horizontally forming, but there will be more variations to it. It can be down sloping or it can be up sloping, as we have discussed in weak trends. So those are wide trading range channels. This is a pure wide trading range, but if in case it is down sloping, then it will be called as a wide trading bear channel. Third is converging trading ranges. You can identify a converging range by using two trend lines, and the both of the trend lines are converging in nature. It means that the resistance line will slope to the downside and the support line will gonna be sloping to the upside. And if you draw extended lines, then they can intersect at a point which is called apex. So they might be looking like a triangle structure forming. And in converging trading ranges, you can see the subsequent swings are shortening, means the urgency in buyers and sellers are increasing. Initially, the range got started in the form of a pullback, but later it started to form a lower swing high, then higher swing lows. So you can say that the structure is formed when you have lower swing highs with a series of higher swing lows. In this type of trading range, also there can be variations, like it can be a tight converging range and it can also be a wide converging trading range. So inside the tight converging range, you should not place any kind of orders to trade in, but in wide trading ranges you can trade by buying at support and selling at the resistance area, because there is enough room to make profit for both of the players. But in converging tight ranges, there is no such room and only scalpers can make money inside those tight trading ranges. The major logic remains same of ranges. It's just a variation of those ranges. The best way to initiate trades in this type of ranges is to enter upon successful breakouts. Here you can see on this chart too that we have had a very good uptrend. Then the market went into a consolidation phase in the form of this converging range, and it has started to form some lower swing highs and higher swing lows, and then the price action contracted, means the urgency has increased. Then within the 2/3 of the total size of this pattern, means the breakout has occurred in the 2/3 size of the complete pattern. So if you just drag these two lines and let them intersect at a certain point, then the total size will gonna be from this first swing point to the apex point. It will be the 100% size of this structure. The breakout should occur in the 2/3 size of this structure, and it actually happened here, and it went into a very robust trend continuation in the upside. Fourth type of range is diverging range. What do we mean by diverging? It is just the opposite of converging ranges. In diverging ranges, you do not have converging trend lines. It will gonna have an up-sloping resistance line with a down-sloping support line. So the swings are breaking the previous swing highs and lows continuously in this structure. Every time the leg completes its move, it go beyond the previous swing lows, and in case of upside resistance, it moves above the previous swing highs. So it is an expanding pattern, or you can also say as a broadening formation, and these kind of broadening formations are a little bit rare in the market. They do not occur too much frequently in the market as compared to converging ranges, but most of the time they occurs at the market tops, and the widening of this range shows that the volatility in the market is very much significant, and 70 to 75% of the times they result in a major reversal. If they are forming at the top, then the uptrend will gonna convert into a downtrend, and when they are forming at the bottom of the chart, then they will gonna convert the downtrend to the uptrend. So this widening formation shows that the market is trading in a high uncertainty environment. So you should avoid trading breakouts in this structure because they are very much unpredictable, and you can try to initiate some reversal trades inside this range with a tight stop loss. So these are the four major type of trading ranges that you should know, and after knowing these four kinds of trading ranges, you will be able to analyze each and every variation of trading ranges. The first one we have discussed is tight trading ranges, the second one is wide trading ranges, and the third one is converging trading ranges, and the fourth one is diverging trading ranges. So although the logic remains same, they all are consolidation phases, but which kind of consolidation is it? Is it an accumulation or is it a distribution? This is the very big question, and very minor difference is there to distinguish between both of them. First factor you need to look to distinguish between accumulation and distribution range is the size of the range. Usually the accumulation ranges are narrower, they are not much wide enough. It means they will not have a high volatile price movement in them, but they will be bigger in duration. It means accumulation ranges takes a higher time to complete in comparison to the distribution range. The distribution ranges will have a very wide formation there, and the duration for those distribution ranges will be short. Those wide distribution ranges shows volatility and uncertainty among players, and the duration is short because a lot of urgency is there to book the unrealized gain and to initiate new short positions. Second thing you can look out for is the location of a range formation. If a new trend has started and after some period it has started going into an consolidation, then you can assume if there is no resistance just above that, then it can be a accumulation range and it will gonna have a second leg to the upside. And on the other hand, if it is forming at the resistance area or some kind of channel resistance zone, or it is forming after an extended uptrend, then it might be a distribution range. So in similar ways, accumulation range will gonna form after a decent fall at the bottom after an extended downtrend, or it can form in the middle of the uptrend. Third factor is volume. In distribution ranges, you will gonna see relatively higher volume when the range is forming, but in accumulation ranges you will see a very low volume activity going on because players are accumulating it slowly without letting other big institutions to know about their accumulation. So that is why accumulation ranges are slower in duration and they are not that much of volatile. They do not have wide ranges. In the last, you can take moving averages confirmations. If a range is forming near a significant moving average area like 200 EMA, then you can say that this range can be an accumulation and you can initiate an entry upon breakout. But if a range is forming far away from the moving averages, let's say they are far above the moving average, then that particular range can be a distribution range because it wants to have a mean reversion towards moving average value area. So moving average can also act as a great confirmation tool. Observe this chart here. We have a very good uptrend going on and this range has formed near the moving average area, and this moving average is 100 exponential moving average. So it has continued the uptrend because the market is forming a consolidation range near this 100 EMA value area. So it has continued the uptrend, and second range has been formed around this zone which is also above the moving average, and it has robustly moved to the upside. And let's follow this structure here. So if we just see this particular trend, then it has formed a very small range at this area which is also above moving average. So these ranges are showing accumulation in the trend. Let's just draw a channel from this range to this swing high. So we have this resistance line forming up here, and if you just focus on this range, it is forming near the resistance area. This is channel resistance, and the range is in the form of a descending triangle, a converging range. So it has reversed the market from uptrend to the downtrend like this. And when the market broke down from this range support area, it has hit this major trend line and moving average at the same time, but the market failed to sustain around this level. It made a retest and continued in the downside direction. So this is how this range formation above moving averages in an uptrend give you a confirmation of accumulation, and if it is far away from this value area, so value area is here and it is forming around this zone which is far away after an extended uptrend, so this is marked as a distribution range. In similar way, see this downtrend. So we know that a downtrend is going on, and here if you see, the range has formed in this value area and we are moving in a downtrend. So you can see the range has been a distribution range and the market fell down. Again, when the market moved away from this value area, it started to form a small second range which has given a small up move towards this value area, and if you go one time frame lower than this one, then you will find this is again a converging range formed here. So we are again now at a value area around moving average and in a downtrend. So this is a distribution and the market moved down. After moving down, the market is a little bit far away from this value area. So the market formed this range which has been an accumulation for the up move, and then again after this retest the market fell down, right? So the market tried to move above this value area, formed a range here, but we are in a very good downtrend. So the market took resistance of these major resistance area and again fell down like this. So these minor ranges far away from the moving averages will result into an accumulation, and near these value area it will be a distribution in downtrend. So this is how you can use the confirmation. Just make sure that you identify the trend direction because that is the most important thing. So that is all for this video. I hope you have understood what sideways market is and how to navigate in these situations. We will gonna cover the psychology of accumulation and distribution phases in our next video. Make sure to subscribe to our community channels to stay updated. Thanks for sticking around. If you found this video helpful, there is plenty more to come in our series on Forex and technical analysis. And don't forget, for all your trading needs, visit tribe.com. For more in-depth trading education, head over to tribehub.com. Thanks for watching, happy trading, and I'll see you in the next video.